Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another of our double shot interviews. I'm joined by Jarrod Kerr, the Chief Economist at Kiwibank. Welcome, Jarrod. Thanks for joining us.
Thanks for having me back.
Jarrod's here to talk about this report that he put out this week. Very nice homage to the Red Hot Chili Peppers. Blood Sugar Brex Magic, markets high on risk. Now, we live in turbulent times, as we've discussed before. This report's really an interesting one. And you're talking about Reserve Bank cuts to the official cash rate that you're expecting, with 2 in coming months and then potentially more next year. You're talking about a volatile descent for the New Zealand dollar. This all sort of paints a fairly grim economic picture. I guess, though, on the surface, New Zealand would still appear to be in a reasonably good place compared to a lot of other OECD economies. So what's going on? What's the reason behind your prognosis?
Yeah, excellent question. I mean, only a week or so ago we had thought that the cash rate would stay on hold and would continue to muddle through a lot of this turbulence we're seeing overseas. But it looks like the balance of risks globally are deteriorating. And some of the stronger economies out there have lost momentum, like the US, and then you look at Europe and parts of Asia, and growth that we're seeing out of that part of the world is also disappointing. So in terms of looking ahead, it's a bit more clouded than we'd thought. So I think we're in a position here where the central bank is looking at our economy and saying, well, business confidence is clearly weak, and there's something going on there. Our currency's quite high, and maybe we should take a bit of insurance out in the next month or so, cut the cash rate 25, 50 basis points, and then see how we go from there. Because cutting the cash rate in May, June, August type area, you're not going to have an immediate impact. Monetary policy lags mean you're really trying to take out insurance on growth towards the end of this year and into next year.
In terms of cutting the official cash rate, obviously it's at a record low where it's been for some time now, 1.75%.
Yeah.
What do you think the Reserve Bank wants to achieve if it does indeed go ahead and cut that? And do you think it will achieve that?
Well, you're trying to ease up financial conditions a little bit more. And if you look at what the banks have done with their mortgage rates recently, you've seen mortgage rates falling as wholesale interest rates have fallen. And we have actually seen a decent tick up from customers in response to that. So there is still a response to falling interest rates. So if the RBNZ wanted to put a fire starter there, cut 50 basis points, a large part of that, if not all of it, will be passed on to both mortgage rates, but also term deposits. So savers will also get hit here. It's a double-edged sword when you're cutting interest rates. You can cut the borrower rates, but you're also cutting the saver rates.
Yes, exactly, which savers will not be too thrilled about, I imagine. You've raised the possibility too of down the line, if they want to continue cutting the OCR, that obviously there are steps beyond that if they were required. Why are you raising those possibilities?
One of the first responses our clients make, the first question they ask us is, if you cut to 125, how much ammunition is left? How much further can we go? We can actually go quite a fair bit further. We could cut to 50 basis points in a heartbeat. The problem is that you get diminishing returns the more you do. So the more you cut sort of below 1%, the impact that you have on the economy is reduced. So you start to think of other things. It's not just an OCR that we can play with. That's not the only tool that the central bank has. If we're in a situation where you've seen, say, a recession in the US or global growth really is turning, we could cut down into those sorts of levels, but then we could also intervene in our currency if the currency is still holding up too high. And that's basically the central bank takes its printing press, prints a bunch of money and sells those Kiwi dollars to a foreigner at a price that they believe is too high. And you can just keep printing until you get the currency coming down. The other thing they can do involves the printing press as well, and that's quantitative easing, where again you print some money, but you give it to the government basically. You go and issue some debt, we will buy it, and we will make sure that the interest rate that you have on that debt is really low, and then now it's your job to go out there and stimulate the economy, boost the fiscal spending, which I think has been lacking globally for the last 10, 15 years.
Now, you're talking about, in your report, the New Zealand dollar weakening quite considerably. I think you've described it as a volatile descent, which you expect to see this year, into the low US 60 cents range, potentially even into the 50s. Why do you see that happening?
So, for starters, we're performing particularly well. So if you look at the Kiwi dollar right now, it's quite high, and it's being supported by the fact that our growth is okay, but growth overseas is subpar. So relatively speaking, we look all right. It's also being supported by our terms of trade. So our export prices are holding really well, and our import prices are soft. So again, that puts support on our currency, but it's the interest rate differential that will change. So if you look at a Kiwi interest rate today, it's actually quite attractive to, one in Australia or the UK or Europe or Japan, which is kind of negative.
Yep.
But we are below the US. And in cutting our interest rate, we take ourselves further away from US interest rates, so there's less advantage there, and we're also getting ourselves closer to those low ones, so there's less need to hunt for yield towards New Zealand. So international investors literally look around the world for high interest rates, and if we take some of that advantage away, it reduces some of the flow into Kiwi dollars.
And a weaker dollar could potentially negate the need for more OCR cuts, do you think?
Absolutely, that's part of the financial conditions. So if we find ourselves in 6 months or a year's time where the currency's gone from 68, 69 cents today to 60 cents, well, that's great. That's a win for us. It's a win for our exporters. It's a win for our economy as a whole. So the need to then cut further is significantly reduced.
Now, I guess from a bigger picture sort of scenario, it's interesting. We're sitting here in 2019 and we're talking about cutting an OCR from 1.75%, possibility of other ammunition such as currency intervention and quantitative easing in the Reserve Bank's toolbox. There was obviously a watershed event happened around 2008, which became known as the global financial crisis or the Great Financial Crisis. A lot of people would argue that policymakers around the world really just kicked the can down the road after that and haven't resolved the fundamental problems that are there in the world economy. I mean, the debt is still really high in a lot of places, including here in New Zealand. Yeah. To what extent do you think that these fundamental issues still need to be tackled? If we were talking about cutting the OCR and stimulating mortgage rates, I mean, isn't that just more of the same medicine that hasn't really worked around the world? Yeah. So
I think the problem we've had is, as you correctly said, is that we've cut interest rates, and that should have allowed us to pay off debt faster and fix some of the problems out there. We're sitting in a situation now where the US has got a lot of debt. That's not a medium-term problem, but I think it's a long-term problem in the States. There are a lot of countries around the world that have a lot of debt. New Zealand's not one of them, and Australia's not one of them either. We have a very small amount of debt, but yes, there are problems.
You're referring to sort of government debt?
Government debt. Household debt, we have a decent lick of household debt. So what we notice, though, when interest rates fall, you do see households repaying the same amount, so they actually do run down their mortgages faster. So there is a repair that does take place when interest rates come off. But what I think has been missing in this post-crisis world has been a lack of government response. Normally when you see interest rates drop this low, governments come out and start building and and expanding and taking over the reins and saying, right, if we're going to have a healthy, productive, high-growing economy, we need to start building some stuff now for 10, 20 years down the track. And we just haven't seen it. I mean, we're trying in New Zealand, but we haven't done enough. And I think that's the disappointment globally, is that monetary policy's done everything it can, and fiscal policy hasn't done much.
So you'd be talking about infrastructure building, housing building, all those sorts of things?
Yeah, absolutely. At interest rates that are ridiculously low. I mean, a 10-year government bond rate at 180, that's the lowest we've ever seen. Now, the government could issue billions of dollars at that rate, and I think just about every construction worker in New Zealand could come up with a project that would easily cover that very, very low hurdle of interest. And we desperately need a lot more infrastructure in this country.
People talk about sustainable growth now. That's a real catchphrase as well, and inequality. Is this a way to address those issues too, do you think?
Absolutely, absolutely. And I think that's a key problem that has developed, or has worsened, I should say, post-crisis, is widening inequality. So the way we dealt with the crisis was lowering interest rates, quantitative easing, so inflating assets, and that generally helps the owners of assets. And income growth outside of that has been quite weak for the general public, right? Our wages growth for the last 10, 15 years has actually been quite weak. So the asset owners, the rich, the wealthy have done okay, and everyone else has either just stayed the same or even gotten relatively worse. So that's your widening inequality. How do you deal with that? It's a tough question, and it's one that will take, I think, decades, but you really need to focus on education, because the wave of automation and AI and this sort of stuff that's coming through could potentially exacerbate that even further. You need the infrastructure so that poorer areas in your country have access to the major cities or have access to employment opportunities. There's a lot that needs to be done, but it costs money.
Absolutely. Well, look, thanks a lot for that, Jarrod. That's Jarrod Kerr, the Chief Economist at Kiwibank, and I'm Gareth Vaughan at interest.co.nz.